Bloomberg Audio Studios. Podcasts, radio, news.
This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. The saga of Paramount Global continues as President Trump moves to settle his lawsuit over a CBS News interview, opening the way for yet another restructuring of the company. It's a movie we have seen before, 3 times, actually. Plus, American farmers may be the victims of their own success. They produce more efficiently than ever, but demand can't keep up with supply. We go to central Iowa to hear from the farmers themselves about what they need to make farming a good business. But we start with the news story being told at the Food and Drug Administration, as President Trump's FDA commissioner sets a different course for the agency amid big changes in personnel. We traveled to White Oak, Maryland, to see for ourselves what the new FDA head, Dr. Marty Makary, is up to, and why he believes it will help make America healthy again. Talk to us about opioid. Did the FDA fail?
The FDA did fail. There were many parts of our healthcare system that failed. Look, I feel terrible about the opioid epidemic. I personally prescribed opioids with misinformation. It was taught to me by my chief resident in my surgical residency. And we sort of woke up to this problem around 2014, 2015, and thought, oh my God, what have we done? What information did we not have? I think was regulatory capture at the agency. Now, we can't prove that, but when the reviewer immediately goes to work for Purdue Pharma after approving OxyContin for chronic pain, and the approval for chronic pain was based on a 14-day study.
Have we seen the last chapter of that?
No, we're going to look at the label for OxyContin and that class of medications and ask, how can we ensure that it's accurate and consistent with the science?
How does your approach to science and common sense avoid the next OxyContin?
One of the first actions I took was to remove all industry members of FDA advisory committees wherever statutorily possible. And so we've got to preserve that scientific process, and we've got great scientists that are doing that right now. The second thing is that we need to have eyes on a drug and device the second it's approved and keep eyes on those drugs. We shouldn't be learning 19 years after OxyContin was approved that it may have killed nearly 1 million Americans in its downstream effects with other drugs. We should be able to approve a drug and with big data, go into big data with our eyes, with our epidemiologists, and watch a drug to see if there are safety signals that emerge. One of the broken things about the FDA that I learned just last week was that bureaucrats at the FDA had the ability, a small group had the ability to block a safety epidemiology study by our own safety epidemiology team. And so we are announcing we're getting rid of that ability to block a safety evaluation. And we want that safety team to work freely without any barriers. There's a bit of a conflict of interest. If you're the team that approved a drug, you may not want to be embarrassed to learn that there's a safety signal down the road.
What can the FDA do about reducing childhood obesity?
So we're doing an inventory of all the chemicals in the U.S. food supply that children eat that are banned in Europe. We're going through them one by one. We're doing an inventory. We have a new office for post-marketing assessment, challenging this old notion, this old regulatory process that was called GRAS, that is, that some foods were generally safe. Well, this has become now applied to novel chemicals in the food supply where people do have significant safety concerns.
One of the most controversial issues raised by Secretary Kennedy's new leadership at HHS has involved vaccines, with a group of medical associations suing this week over the withdrawal of some recommendations about coronavirus vaccines. Looking back now on COVID and the development of vaccines for COVID, was that a success story? Was Warp Speed a success story or not?
I think it was a success story. Remember, when the initial vaccines were released, they were a very good match for the circulating strain at the time. There was low levels of population natural immunity, And we clearly saw a reduction in the severity of illness. But now we're 4 years out from those initial randomized controlled trials. And parents are appropriately asking, does my 6-year-old healthy daughter need 65 more COVID shots in her annual lifespan, that is 1 each year, or not? And that is a scientific unknown. We'd like to see a clinical trial.
What about measles? Are you worried about chilling effect of the government really raising questions about some of these vaccines that cause people not to get vaccines they ought to be getting?
Vaccines save lives. Let me be very clear about that. But we, at the same time, have seen a loss in public trust in doctors and hospitals. Why was that? In my opinion, it was because public health officials did one of the worst things you can do with the authority and power you have as a physician, and that is demand that people do something when you're not really sure, and you're not honest with them that you're not sure.
Many of us think about the FDA for the D in the FDA, which is drugs, and particularly approval of new drugs. What parts maybe aren't working or you think you might be able to help fix?
So not only have we spent a lot of time with individual reviewers, pulling them aside without their bosses and asking them, what have you always wanted to do here? What do you think could work better? We've done a national CEO listening tour now in 7 cities around the country where we're in the middle of it, where we're asking CEOs, what ideas do you have for a better FDA? We need an FDA that is user-friendly. Drug developers and inventors of new drugs are trying to figure out how do they get through this long, gnarly regulatory process? Well, we can be more transparent. We can provide better communications, we can provide guidance, we can answer questions on demand, and we are announcing that we're going to make our decision letters public so that drug developers can see why drugs are not accepted at the FDA.
Why weren't they public?
Some of the drug companies don't want them public. We learned that most companies will spin the results from the FDA. The company will not even say that the FDA is asking for a new clinical trial when we've asked for a new clinical trial in our decision letter. So there's an opportunity for companies to sort of spin the results, make it sound like, oh, the FDA got it back to us and they just want to see one small tweak.
If in fact there's more disclosure about letters that say we're not approving your drug, could that help the rest of the industry make progress faster on developing the right drug? Absolutely.
Look, we need more transparency. The FDA has been a black box, and companies have scratched their heads to try to figure out, what do the reviewers want? Why are they rejecting a drug? Did they actually reject it with a big rejection or just ask for a small modification? Well, no one's known because none of this has been public information. Well, that's going to change.
How do you make sure the FDA is up with the most recent technological developments?
Yeah, so we've got to modernize. We've got to keep the best people here. We've got to listen to what's happening in the field. And AI is a good example of that. We're using AI to organize these gigantic applications that can be 100,000 pages. And we now have thousands of scientists at the FDA using it every day on their own volition. That is, it's an optional feature. They find value in it. They're using it. And so all of these things are designed to modernize the FDA, to ask the big question, why does it take over 10 years for a drug to come to market? We introduced a pilot with a new priority voucher, where if a drug or a company's priority is in our U.S. national priority, we have vouchers now in a pilot program to give companies a decision in 1 or 2 months instead of nearly a year.
Can you increase the speed without taking a risk on the safety?
I think you can.
Commissioner Makary admits to a good deal of change at the FDA, change that has led to the departure of some very senior, long-time leaders and the loss of a good number of positions altogether.
So the FDA doubled in its number of employees since 2007. Now, there were massive redundancies with 12 travel offices, over 2,000 HR and budget procurement personnel. There were duplications of services. There were clunky adverse event reporting databases that were all built from scratch. So we can benefit from a lot of great consolidation in IT and communications and so many other areas. but we have to make sure our scientific reviewers and inspectors have everything they need.
At Bloomberg, we focus on investors often, and capital counts when it comes to biotech. Change is not something investors usually like. How do you think your changing of the FDA may affect investment?
I want investors to know that we are in a deregulatory mindset. We're cutting red tape. We're going to speed up the approval process without cutting any corners on safety. We're going to continue to invest in our scientists and inspectors and all the core staff central to their function. And we're going to create predictability with clear guidance. We are talking to industry constantly to figure out how we can be helpful, which of their products being proposed are in line with our national priorities, that is, meeting a large unmet public health need, domesticating manufacturing as a national security issue, increasing the affordability of drugs, which is an access problem. This president does not like to see Americans getting ripped off. And we've been paying more for drugs than in many wealthy countries around the world.
Can you do anything about that?
We can issue a national priority review voucher for companies that are promising to equalize the price between other OECD countries and the United States, even with other products that they currently have. And so we want to incentivize good behavior in the marketplace.
Coming up, battle lines are being drawn in the trade war right through the cornfields of rural Iowa. We bring you the story from the heartland of high tech driving high productivity and a desperate need for export markets to ramp up demand. That's next on Wall Street Week. This is a story about abundance, an abundance of food, and whether we can ever have too much of a good thing. The United States has the most productive agricultural sector in the world, something every president, Republican and Democrat, embraces.
Since 1933, the government, your government, has been a friend of the farmer.
Farmers.
U.S. farmers.
America's farmers.
And I love them, and I'm never going to do anything to hurt our farmers.
Welcome to Iowa, where dusty roads pierce through over 20 million acres of corn and soybeans. The towns are small, and the skyscrapers dotting the horizon aren't office buildings, but grain elevators. This is America's heartland, and farming runs in the blood.
I am the third generation. My grandfather started farming in Nebraska for generation one, and in the mid-50s moved here to central Iowa. And my father continued, and then now me after.
What brought your grandfather to Iowa?
The situation in Nebraska was three brothers farming together. They weren't able to accumulate enough acres, and then drought situations in Nebraska decided that they should split up. My grandfather moved to Sioux City, Iowa originally, and farmed there for a couple years, started a dairy herd. That didn't work out, so then there was an opportunity to rent and buy this farm.
Are you hoping your children will continue in the farming business in some way?
I certainly do, and I think that that was something that I'm very proud of, to pass on that tradition, that appreciation for agriculture to all of my kids.
This I have not done. That's Stu Swanson. His farming family has seen dramatic changes in the business of agriculture since his grandfather came from Nebraska 75 years ago.
So each acre of corn will cover 3 times with this machine.
Over that time, U.S. farm productivity and output has nearly tripled, helped by technological innovations. With that explosion in productivity has come larger and larger farms, including for Swanson, who now farms about 1,900 acres, a third of which he owns, with the rest owned by investors from as far away as Norway.
Yeah, I think for this time of the year, in mid-June, the corn looks about as good as any. I've farmed for 33 years, so this is my 33rd crop that you're walking through today. Other than a little excess water that we've had in the last few days.
Well, I was just saying, my boots are sinking down here as we walk through it. But also, look at the color of the soil. Why is this so rich?
We're lucky that the glaciers moved the topsoil here. We also are in an area of Iowa and of the country that is called the Prairie Pothole region. So we have really rich organic soils from the previous plants and things that were grown here. And so that high organic matter gives that black color that we are very proud of here in Wright County.
That might all sound like good news, but as president of the Iowa Corn Growers Association, Swanson knows all too well the challenges facing America's row crop farmers. A lot of farms, I understand, are actually cash negative. Are you cash positive?
I haven't ran a number to tell you today. Certainly, we know that over the last 3 years, we've seen about a 30% decline in commodity prices. I think over that same time, we've seen the 9 major crops all be underwater, so we are producing at a loss on the 9 major crops.
Gold Eagle Cooperative is an intermediary for farmers in the markets they serve. It is located on the outskirts of Eagle Grove, a short 20-minute drive up the road from Swanson's farm. We sat down there with Tom Halverson, an Iowa native himself.
I remember when my grandfather started, when I was a little kid, he had a little tractor with a harvester that would do one on each side. He'd be going back and forth in the field like this for a couple days.
After working around the world for Goldman Sachs, he's now CEO of CoBank, which operates as a farm credit bank, counting as clients both Swanson's Farm and Gold Eagle. Halverson has a front row seat for the storm brewing over America's crop farms.
Corn, soybean, and wheat prices are meaningfully lower than they were a couple of years ago. That translates into, lower cash flows for the producers themselves. At the same time, rural Americans in general and farmers in particular are not immune from macroeconomic conditions, including inflation, for example. They are incredibly exposed to trade, buying and selling internationally. Producers have been squeezed quite dramatically over the last 12, 18, 24 months by a combination of lower commodity prices for what they sell on the one hand and significantly higher prices for the inputs.
Once seen as the supermarket of the world, America is instead finding out the hard way that the world is doing its grocery shopping elsewhere, and has been for some time. This year, the U.S. is expected to record its 3rd consecutive annual trade deficit in agriculture, something that hasn't happened in 70 years. Javier Blas covers commodities for Bloomberg Opinion.
I think that the reversal on the agricultural trade in the United States is a structural feature. I don't think it's going to go away. And there are 2 elements there that are very important. One is that the United States is importing more agricultural commodities than they used to. And the reason for that is that we like to have green beans and strawberries and other agricultural crops the whole year. We don't really want to buy them when they're in season. The other problem is that the United States is starting to export less agricultural commodities, and that is a lot in part due to Mr. Trump's trade policies. If you are hurting one of your largest buyers, one of the largest importers, one of the largest customers of American food industry, that's China. The big problem for the United States agricultural sector right now is that in the past, if a country was having a big disagreement on trade policy with the United States, it still needed to continue buying corn and soybean and wheat from America because it didn't have any other options. Today, there are many other options, and particularly one, and it's Brazil. Brazil, over the last 40 years, have transformed itself into the supermarket of the world. That is a role that the United States used to play in the 60s, 70s, and all the way into the 80s. The damage is done. Every time that you scare buyers, the buyers are looking for an alternative, and they will have very long memories. Japanese soy importers still remember the very brief trade embargo imposed by the United States more than 50 years ago on soybeans. And that is half a century later. The buyers still remember that. Once you open that door, you cannot put it back. It has been done, and I think that the damage is done.
As far into the future as we can foresee, the agricultural economy of the United States is very, very dependent on access to overseas export markets. My uncle, who lived about a mile from where we're right now sitting, was one of the first American farmers to go on a trade mission to China in the late 1970s. And back then, we didn't sell any soybeans to China. And since that time, we've grown our export market to China from 0 to being the biggest export market. And until our recent trade disagreements with China, we got up to the point where it wasn't yet 50%, but it was closing on 50% of all U.S. soybeans got exported to China, which is an inconceivably large amount of soybeans that are being grown in this part of the world, put on trains, shipped to the West Coast, put on ships and sent to China. And so, we now have a very significant vulnerability to the need to sell our soybeans internationally because we produce way more soybeans now than we possibly consume in this country.
With China and others now looking elsewhere, the U.S. is finding ways to drum up domestic demand. Part of the answer lies in alternative uses, and that's where Chris Boshart, the CEO of Gold Eagle, comes in.
We're about a 3,000 member owned cooperative. We provide goods and services to farmers. So we provide a lot of agronomy services where we'll sell farmers seed, fertilizers, crop protection products to help their crops grow. Our feed group will take farmer corn and grind that, blend that, and feed that back out to livestock. And then our grain division, we take the farmer's corn in the fall or whenever they need us to be there to deliver it. We try to help them find the best markets. We do have a partnership with an ethanol plant, so we manage an ethanol plant that's just right out the back door here. We grind about 30 million bushels of corn a year. We're making about 90 million gallons of ethanol out of that corn, shipping it all over the country into our liquid fuel supply.
When you and I think of corn, we may think of corn on the cob, corn chips, corn starch, or even popcorn. But only about 8% of the corn America produces is eaten by humans. The majority is crushed and turned into livestock feed or processed into ethanol and used in gasoline.
We think that the ethanol policy gets debated around from time to time. The current administration talks a lot about domestic energy production and has been really good for biofuels. And we've seen biofuels be a real bipartisan solution over our history, and it's really been good. And so as far as corn demand today and where corn demand can grow into the future, we really think that there's a huge potential for ethanol to continue to be a bigger and bigger part of that local demand.
The same transition from food to fuel is happening for soy.
Now we're trying to find alternative uses, for example, to those soybeans, some of which can be turned into alternative sources of fuel. So for example, the government announced some changes to the renewable fuel standards and so forth that have been very, very good for the soybean market.
But that may be only half the story. As farmers reel from a challenging export market, higher interest rates have delivered a second blow in what turns out to be a pretty capital-intensive business.
The high horsepower tractors in new situation is probably $600,000 to $700,000. This machine was actually built in 2009. It's probably the oldest piece of equipment that we utilize on a regular basis. So its value as it sits today, probably $150,000 to $175,000. So
how fast do they depreciate?
Yeah, really fast.
Farming is such a capital-intensive endeavor, whether it's the cost to finance their land acquisitions, just their interest rate to put the operating loan in, to put a crop in. They're investing hundreds of dollars in acres just in the input side to put the crop in, and then their machinery and equipment purchases have just really skyrocketed in the last 3 years.
Rising costs and falling prices do not add up to a successful business. So what do America's row crop farmers do to make ends meet? And how much of it depends on the federal government? That's where we turn next.
We don't want to rely on government payments. That's the last thing that we want to do.
In the cornfields of Iowa, farming is more than just a business. It's a way of life passed down from generation to generation. So do you come from a family of farmers?
I do. I am the third generation.
I was born on a farm in southeast Iowa.
When my grandfather came here, you couldn't farm very much in this part of the state because it was all water. It was wetlands.
This is where I grew up, and I'm the fifth generation, so we're raising the sixth generation here on this farm. So back in the late 1800s, my great great-grandparents would have came here and started the farm.
J.D. Meyer's farm lies a short drive from Stu Swanson's.
You'll start seeing, I don't know if we can see it yet, but you'll start seeing an ear shoot.
And he too farms corn and soybeans, but where Swanson is the third generation in his family growing row crops, J.D. Myers is fifth generation and plans on passing it along to his own son.
300 bushel on the bottom of that bin that's left, so take a few loads to get up there. Yep. But other than that, we'll be done, and then we can grease the shivers and get it ready to go.
For decades, passing it on to the next generation has been the story of American farms. But the agricultural workforce has been in steady decline, from 8 million in 1949 to just over 2 million today. Technological innovation has certainly made farming more efficient, but urbanization has also contributed.
As folks have moved into the cities, and we even see that here in Iowa, there's definitely an urbanization trend, and that's all good. I mean, that's all good and well. But I think that the value of folks really truly understanding where their food and fuel come from, there's just tremendous value there, and we need to keep doing that as ag leaders to keep telling that story.
But if Iowa's farming families hope to pass their way of life onto the next generation, it has to be a sound business as well as a way of life. And the combination of low prices and higher costs has meant that farm income has plummeted over the past few years, meaning that sometimes financial institutions like CoBank have to make up the difference through loans.
We rely not only on CoBank, but local banks to help provide financing. The cost of production is at such a high level, and it just keeps increasing, that we need that backstop to know that we can average cash flows out.
One of the most important indicators of credit quality for the farm credit system, and indirectly for farmers as well, is farmland value. Right, so we watch very carefully what's happening to farmland value. My family owns some, so we watch it too. And farmland values are always a massively lagging indicator. Commodity prices have come down a lot, right? Corn's down, beans down, wheat's down since the peak 2 years ago. But farmland value is still like this. It has sort of stopped rising in the way that it had been rising for a long time. But as you can imagine, if prices stay low and cash flows are negative for a lot of producers, they don't have free cash flow and working capital, and they have to draw down, because farmers tend to be asset rich and cash poor, right? They own land and physical assets and machinery and stuff that's worth things, but it's not liquid. So credit quality is actually pretty good. Balance sheets of most farmers were in good shape, until the last 12 to 18 months. But this stress period that we're now in is going to manifest over coming 6, 12, 18 months, and that'll show up in tougher cash flows, people needing to raise liquidity in other ways.
Farmers can't keep borrowing forever to make up shortfalls, but there are signs that things could turn around, not because of higher prices or lower costs, but because of the government, something farmers like JD would rather not rely on.
Biggest thing, I guess for me as a farmer is that I want to make sure we have markets. I don't want direct payments. I would rather not have direct payments from the government. If we can have markets that will buy the grain and stuff from us, not have to depend on the government for it, and develop those markets.
We don't want to rely on government payments. That's the last thing that we want to do. We've worked to try to eliminate that, and we want to try to create demand through domestic markets, through exports, to offset that.
Last year, the U.S. government paid out roughly $9 billion to farmers. This year, that figure is set to surge to an estimated $42 billion, much of it aimed at weather-related disaster relief and support for those in financial distress. Still, the role of subsidies raises tough questions. After all, the U.S. didn't bail out DVD manufacturers when streaming upended the industry. But then again, DVDs are a luxury, while food is a necessity.
Now, your viewers who are not close to this would probably say, well, why do we do that? And how much do we do that? And what's the explanation for that? And to which the answer is, if you travel around the world, as I have in my career, you'll realize and know that feeding your population is a national security consideration for everyone on Earth, right? And we kind of take that for granted here because we're so productive in our agricultural economy. We don't just feed ourselves, we feed a lot of other people all around the world. But being able to have a food self-sufficiency and a comprehensive, productive, safe, secure sources on a through-the-cycle basis of food and fiber for the United States of America is frankly a matter of fundamental and vital national security interest. And in order to safeguard that, we have put in place over many decades in this country a whole bunch of support infrastructure to ensure that we will be able to feed our population under any and all circumstances. And that infrastructure has been enormously successful for so long that almost all Americans take it for granted.
Is there also a risk in terms of business and the economy in ongoing subsidies to farmers?
It's a very important question. You know, I never met a farmer that wants to make a living at the expense of their fellow tax-paying citizens. That is a true statement. On the other hand, just like every other advanced industrialized country in our peer group, so think Japan, France, UK, Germany, or whatever, because of the national security implications and so forth, you've got to have a good, stable food supply. You've got to make sure that that's taken care of. So you can't leave that 100% to the vagaries of the marketplace. And so it's not a surprise, therefore, that all of our peer countries have a similar kinds of mechanisms in place to ensure that and to ensure the care and well-being of the rural land. But having said all of that, it is a risk that if you take too much too often and get your significant risks taken off the table for you whenever they manifest by the government, that you're subject to the risk of the complacency of thinking that that's always going to happen. And that can be true in a variety of ways. And I think in our country and in our society these days, there is a tendency for the population to want the government to de-risk things when they go wrong. All those things are legitimate and reasonable, but they also, over long periods of time, change people's behavior in the marketplace. And the market starts to take risks that end up becoming mispriced. You know what I mean? And they end up that the people who are having to provide that support are going to have to provide more of it more often than would otherwise be the case. And that is a risk for the agricultural economy. The Congress, I know, grapples with this on a consistent basis to try and determine the appropriate and most effective place level for this, right? It needs to be enough to ensure that we safeguard the stuff that we think we need to safeguard for the best interest of the country, but not so much as to create bad risk-taking behavior or unsustainable subsidies or to stimulate overproduction that we don't want or need.
If we don't have a strong agriculture sector, if we can't feed ourselves, we are no longer the superpower in the world. And so all of this, it's a complicated sort of balance that we're striking, that we're working to achieve.
President Trump's Secretary of Agriculture, Brooke Rollins, has a packed travel agenda, visiting the likes of the UK and Italy and scheduling trips to India, Brazil, and Peru, all in an effort to drum up overseas interest in U.S. agriculture.
Specific to soybean, corn, really our row croppers, that's really a very direct result of China. And I know we're making progress on China. We'll continue to make progress, hopefully. But if we don't, opening up markets all over the world. Listen, EU, for example, charges a 10% tariff on average on American products, and vice versa, we only charge 5%. That's 2x. The average tariff charge around the world is about 15% on American products, when we charge on average 5%. We've been taken advantage of over and over and over again. So as we are realigning, we're also opening up these markets with the trade deal. So you'll continue to see this moving forward. Now, if around harvest time, into the summer, beginning of the fall, we see some real economic harm with our farmers, our president has been unequivocal. unequivocal in saying that he's got the farmers back. And if there is short-term consequences, we'll make sure to do everything we can to mitigate that.
Yet mitigation through subsidies could be detrimental to the farmers of today and the generations to come.
I'm a big believer that ultimately market forces are the most important thing. But government policy can be either a tailwind or a headwind, or sometimes it's confused and it's both at the same time.
And right now, the market forces have swung against farmers.
So you put that all together, it's not good business to be a farmer in America today. And when the business is not good, what you see is that ultimately some farmers will call the day. But more importantly, and I think that here is the big problem, is that we are going to see the children of those farmers deciding that farming is not their way of living.
Right now I'm going to Iowa State. I hope to come back and, try some new things on the farm and continue to grow it.
America's history is rooted in agriculture. For J.D. Myers and Stu Swanson, it's run in the family for generations, and their children are set to continue the tradition. But for the tradition to continue, they will need robust export markets for what they produce. The technology is there, the land is fertile, but ultimately there has to be a solid business to make sure someone's around to farm it. Coming up, breaking up may not be hard to do after all, as Discovery moves to break up with Warner Brothers, even as Paramount Global tries to get together with Skydance. That's next on Wall Street Week. This is a story about the company we keep and the company we lose. Sometimes the world of corporate restructuring seems like an episode of The Bachelor, what with all the theatrics of getting together and then very publicly breaking up when the partnership doesn't go as planned.
Warner Brothers Discovery announcing that they would be splitting into two different companies.
Changes are coming to Comcast, the media giant announcing it will spin off its cable TV channels, including MSNBC.
A deal finally between CBS and Viacom.
The media world has been particularly eager to break up and get back together again. CBS merged with Viacom in 1999, split in 2005, and came back together in 2019. Now, renamed Paramount Global, it's on its way to merging with Skydance. And the saga of Warner Brothers is almost as complicated.
It's kind of the trend, I think, and it's a cycle that seems to happen over and over again, and people don't really learn their lessons. AOL Time Warner was not that much different than Time Warner, then versus how you look at Warner Discovery today and how they saw AOL.
Mark Patrikoff has spent a career as an investment banker and technology investor, specializing in media and entertainment deals. He now heads Patrikoff Company, working with athletes on their private investments.
Content's always going to be the most important thing. It's one continuous part of our industry that we know you can't really change radically. It's about talent and creativity, and it continues to hold value. And distribution will catch up and recreate itself, and new technologies will come, but the content's the constant.
With all the back and forth, when does it make sense to merge companies or break them up? And most importantly, when does it work for shareholders and when does it not?
We see every year add half a dozen to a dozen of these spin-offs and breakups of S&P 500 companies. The long history of that is that on average, they perform average, and they end up essentially receding to S&P 500 kinds of returns.
Greg Taxon is the managing member of Spotlight Advisors, consulting with corporate boards on activist shareholder campaigns, shareholder proposals, and capital structure debates.
There are outliers where splitting a business makes a lot of sense and can actually add value, both on a valuation perspective or a growth and opportunity perspective. But by and large, these things don't really create value. I think when you look at those indices, which basically buy the spun out entities and hold them, they tend to perform in line or under the S&P 500. So on average, these things don't really create value. There are times when a spin out or a sale can enable something different, but it's only really when
the spin-out enables the two businesses to engage in some activity or attract people or investors that are different than the conglomerate, that these things really work.
The fact that a company has different business lines growing at different rates doesn't necessarily mean it needs to break itself up.
The fact is that the people who are running every division inside a business are pretty focused on that business. And it's unclear to me, at least, how separating it into either a separate public company or selling it creates more focus out of the people whose job it is to run that business. There are very complex businesses that perform incredibly well. Think Amazon, which has two very disparate businesses with Amazon Web Services and all of their retail, and even within retail, an advertising business, a physical business with Whole Foods, an online business. They got lots of things. They seem pretty focused on creating profit and growth and value. And it's unclear to me that separating any one of those, putting Whole Foods back out as a public company, would actually create more focus on the part of the people that run that business.
Julia Sneehor is a professor at the University of Navarra. Professor Sneehor's study of spin-offs like Hewlett-Packard splitting from Hewlett-Packard Enterprises has led her to conclude that there is what she calls an ecosystem that can trigger corporate splits, one driven by the balance between complexity and complementarity.
A recent split of eBay from PayPal, where the digital payment, the fintech, started to evolve much faster than the second-hand marketplaces, where the eBay, the corporate parent, was competing. And so this difference in growth between the payment business model, where PayPal was looking at serving many different customers in addition to eBay at a much quicker pace with a much higher complexity, was very different from the marketplace, more mature business model of eBay. And this divergence over time, this increasing difference between the two business models within the same company led to a split in this case. In the case of HP, where HP was originally selling computers, selling printers with a razor and blade business model, but it got also into software, particularly cloud, that started to grow at a very different pace in the 2010s compared to what was happening in the computer commoditizing ecosystem. We saw in the 1980s a lot of conglomerates building up, and in the last 20 years we see GE, Siemens, several companies in this wave of deconglomerization becoming much more focused, and investors looking for pure plays out there. In the last 10-20 years we see the separation between investors who want growth and investors who want value. And for a company that pursues both, that has a cash cow business that is delivering high dividends to investors and has another business that is growing a lot and needs a lot of investment, it's very hard to balance these two businesses. It's like riding a skateboard with one foot and riding a scooter or Formula One car on the other foot.
When it comes to the media sector, Patrikoff's experience is that these spin-offs and consolidations are all about the relationship between distribution and content.
It seems like these companies merge when they feel afraid of the distribution and they need to own the distribution. But then when a better distribution product or technology enters, they of course want to move to that. And that devalues the deal that they did when they merged. It's like cells coming together and cells separating and cells coming together again. Discovery with all these networks really is a legacy of the cable industry. So cable was distribution. Content filled distribution. And as soon as that distribution channel seemed less interesting, late 90s, you had AOL convincing the media giants that they were the future of distribution.
Cells may come together and separate regularly in the media sector, but when it comes to the particular area of sports entertainment, the get together, break up, and get back together trend doesn't apply.
98 of the 100 most watched television shows in the last 12 months for sports programming. I mean, appointment-based programming, live entertainment. It's the ultimate non-scripted, of course, because you don't know the outcome.
Why isn't there dilution? In a lot of entertainment, you get dilution over time as you add more and more. So far in sports, I can't see it.
Because I think the cream rises to the top. And it's the same argument that people have with, will women's sports ever generate significant amounts of value? And our ancillary sports, whether it's volleyball or men's or women's or the Olympics. But basically, there's so much value in these few assets that are out there, and they put so much money and energy into marketing them and maintaining them that the consumer only has so many hours in the day. And if you are a fanatic of football or basketball, there's enough to satiate you over the course of a 12-month calendar year that you're not really going to take a lot of time to put it to other sports.
Unlike the rest of the media world, sports investors are looking to get in rather than looking to get out of slower growing business lines. So what does that mean for potential investors?
There are plenty of funds out there now that have raised a large amount of money to take minority stakes in NFL teams, MLB teams, NBA teams. I think it's an interesting idea. I think it helps professionalize the sport. It's certainly driven up the valuations. I'm just not sure how those limited investors, those small investors buying 3% of the Spurs or 5% of the Giants or 3% of the Dolphins, without a path to control, without a path to exit, without information rights, it's probably inevitable. I think the teams are going to have to be public entities at some point down the road. The valuations are getting too high. There won't be enough billionaires to buy them. It will require board of directors to run businesses of that scale. Community representation, minorities are not represented at the ownership level the way they should be. So you need racial diversity at the ownership level. There's a lot of things that are going to come into play now, as these are no longer family businesses run by patriarchs of family-run companies from the 50s.
Whether it's traditional media coming to terms with the changing world of distribution, or sports leagues and teams basking in the glow of ever-increasing interest, the one constant is the quality of content on offer.
Content is king. I think content is the one constant. There will be content. Consumers will want to experience original content, non-scripted content, sports content, what I do for a living. I think that that's something you could always count on as having value. And then the question is, how is that value achieved? How do you monetize that value?
And there is ultimately one source for that high-quality, compelling content, and one rule that has stood the test of time. I worked for a man who ran Cap Cities ABC. He used to say, sooner or later, all the money goes to the talent. He was talking about shortstops back then.
I get it.
Is that true?
Sure. Look how much money the NFL quarterbacks are making. There's going to be a separate salary cap for quarterbacks for the next 2 or 3 years. I'll also give you a prediction, and hopefully we'll sit down again in 5 years. It's inconceivable to me to think that NFL quarterbacks and other prime positions, and then we'll go to the NBA and other sports, won't be owners of the teams they play on, and that'll be part of their contracts. Why would a chief technology officer at a Facebook or Google get equity in that business, but Joe Burrow doesn't get equity in the Cincinnati Bengals? So the talent is driving the value. They are part of the ecosystem that historically had been undervalued, while the owners and the media rights holders and the people building stadiums were creating all the wealth. But that pendulum has shifted. And that's part of our business model, but more importantly, it's appropriate because they're the ones who are doing the work.
In the end, it turns out that the company we need to keep isn't so much the corporate form or name, it's the company of outstanding talent. Talent that can create the content that is king. That does it for us here at Wall Street Week. I'm David Westin. See you next week for more stories of capitalism.